Hi guys, this is chapter number 3, CFA Economics level 1. My name is Ch.imranahsen. You can search me by placing my name Ch.imranahsen on YouTube. Okay, this is our production analysis. So let's see what is coming. Okay, introduction. 3F consumer we have studied. Consumers' demand for goods. 3F firm. Supply of goods and services by firm. So we have two sides: demand by consumers and supply of goods. Those goods by firms. Objective of the firm. Every firm work for the mostly objectives are profits. So profit in general terms are total revenues less total cost. What you are getting minus what you are paying, the remaining will be your profit. Accounting profit is the net income as determined using accounting principles. You are using accounting principles, so by applying those principles, what you get, that is accounting profit. Accounting profit equation is equal to total revenues minus total cost. The cost in this case are only explicit cost. What is explicit cost? We will talk about this later. Economic profit. Economic profit is equal to total revenues minus total economic cost, and total economic cost includes the implicit and opportunity cost. So let's see what are these costs. Implicit and explicit costs. First we have explicit cost. Cost which a firm actually pays. Whatever a firm is paying, paying is called explicit cost. That include wages, cost of raw material, cost of office stationery, and anything else which is actually paid by the producer a firm. That is called explicit cost. Implicit cost, let me explain. Cost which a firm do not actually pays. It happens, it exists in total cost, it exists. This is what an implicit cost is. Like opportunity cost, a firm is not actually paying this cost, but it is hidden somewhere in the total cost. Let's say what is opportunity cost. Let's see. The cost of best alternate foregone, what you left, that is your cost. Example of opportunity cost. Let's say you are doing a business which gives you 1 lakh per annum dollar, and also you have an opportunity to do a job which pays you $90,000 annually. Because you choose to do your own business, of course it is paying you more, that's why you choose it. But you are missing $90,000 along with other business costs. This 90,000 is your opportunity cost. So this is implicit cost which you are not actually paying, but it is your cost. Normal profit versus economic profit. Normal profit is the accounting profit which just both explicit and implicit cost covers. A profit which is covers all of your cost including explicit and implicit cost. That profit is called normal profit. Normal profit is equal to accounting profit minus economic profit. Abnormal profit or supernormal profit, what is this? Accounting profit is equal to economic profit plus normal profit. So this is the profit which you get from the opportunity cost. This is actually your opportunity cost, but in accounting profit we don't calculate opportunity cost, so we don't minus. So this is what we are going to add in your total profit. So that is economic profit plus normal profit, that is abnormal profit or supernormal profit. Example, for example, you have $1,000 revenues. Total explicit cost means raw material, wages, cost of stationery, and cost of stationery actually is not your direct cost. So we normally don't do this with stationery cost. Let's say this is cost of machinery. Okay, so these are add up, and it is $500. Opportunity cost is 400, which we are missing. So accounting profit is 1000 minus 500. Only 1000 minus 500 is, so 500 is your accounting profit. But in economic profit, we are going to minus this 400, which is your opportunity cost. So we have economic profit of 100. So normal profit is 500 minus 100, that is 400. Okay, economic rent. Economic rent is what you are actually getting by limited supply. You have a limited supply. If this is fixed supply line, which is look like this. So whenever demand increases, only price increases. There is no increase in supply. So from here to here, price increases. So this increase is due to the demand. We are moving from demand 1 to demand 2. So this is called economic rent. Economic rent is the high profit attributed to a fixed limited supply. Revenue, cost, and profits. Let's see what is this. Total revenues. Total revenues, total receipts from the sale of goods or services. Total revenues is equal to price into quantity. So what we are getting, it includes cost, it includes everything else. So what we are receiving, that is called total revenue, price into quantity we sold. Average revenues. Average revenues, mathematical average of revenues per unit sold. So what you are selling divided by what you are getting, total revenues divided by your quantity. So this is your average revenues. On average, what we are getting? Marginal revenues. Marginal revenues, revenue on next unit sold. But you there is a change in total revenues by selling one extra unit. So that change is called marginal revenues. Marginal revenues is equal to change in total revenue by change in quantity. So change in total revenue divided by change in quantity. Factors of production and production function. The factors of production are the inputs which we are inserting in our business model to get some output. So factor of production are inputs to the production of goods or services. There are 4 factors of production: land, labor, capital, and organization. So these are 4 factors which we have to use in order to produce any type of good or service. Production function is the relationship between the quantity produced and factors of production. What we are inserting and what we are getting out of it, that relationship is called production function. So Q is a function of K and L. K represents capital and L represents for labor. K represents for capital because in Greek capital was originally used with K. So we have a symbol of K for capital. So K and L, quantity output is a function of K and L. We have these 2 factors of production which are actively and directly involved in production function. Land is not directly and actively involved. Organization is not directly involved. And some economists lay more pressure and emphasize on labor and capital. So let's say we have a production function. Q is a function of K and L. What is this? If quantity of capital increases or decreases, it has effects on quantity of output. If we are increasing our number of laborers and are decreasing, it also has effects on output. So these both factors are having some impact on quantity. So this is a production function look like. Thank you for watching our video. Please subscribe and hit like. You can comment if you have any problem with that. You can comment it. I will respond. Thank you.